President Trump signing an executive order last week that would make it easier for 401ks to include alternative investments like private equity and crypto. In May, retirement services provider Empower announced its own program to pave the way for private markets to be included within retirement plans. Joining us now is Ed Murphy, Empower CEO, who can confirm that we were together at 1 Beacon Street at the Merrill Lynch office. We were in the same. You trained a little bit after I did, right, at OLP, One Liberty Plaza, and you had the same Series 7 book to study, and you went into production in Jack Joyce's office where I was. But you stayed.
Here we are, reunited.
And here we are. Were you a success? Did you make vice president?
I think I made senior vice president.
Ooh. Well, now look at you.
Fancy.
You're like a CEO, and I'm reading a teleprompter. That was the thing that kind of that angered me. Anyway, it's good to see you. We knew all the same people, and a lot of them are still in the business.
It's incredible. Yeah.
It really is incredible.
Great firm back then.
Andrew is hot to trot on this subject, I think. Private investments.
Love it.
And you for it. I mean, you got to.
I don't know if I'm excited about it, and I'm a little worried about it.
Yeah.
How about that?
Yeah, that's fair.
But everybody should have, for their retirement, should have as many options as possible. And people have done very well in private equity, but usually you had to have a lot of money to do that.
Yeah, we think about this as a sort of democratization of private assets, right? I mean, if you think about defined benefit plans, pension funds, endowments, foundations, they've been investing in private asset for 30 years, right? 3 decades with really good results and positive returns. And if you look at the defined contribution space, we have 120 million Americans in the system, 12 trillion in assets, excuse me. But no, the focus has obviously been exclusively on public equities and public debt. And I think the time has come to open up the aperture. And there's no reason why savers in the 401k system shouldn't have access to the same strategies that endowments, foundations, defined benefit plans have had access to. And by the way, I think there's so many examples of this around the world, you know, whether it's the Nest system in the UK, whether it's a superannuation in Australia. Many of these defined benefit plans are allocating anywhere between 15 to 40% to alternatives. And so, you know, what we've done is we formed a partnership with several alts managers to essentially provide access to these strategies.
So the question, though, that I have about the private piece of this is 2 things. One is, yes, over the last 30 years, private equity, if you will, and some of these private alts have outperformed the market. They truly outperformed the market in the first 10 and 20 years because it was a less mature business than it is now. There is a convergence happening between the public market and the private market as it relates to just valuations. That is actually happening, and that meaning performance has actually come down, not up, in privates. If you just sat in the S&P in the last 20 years, for the most part, you probably outperformed, actually, most privates. You just did. And so the question mark is, for the illiquidity of whatever is going to happen, is that a worthy trade for most people? How are we going to get everybody out when they need to get out? We've seen when things get a little bit complicated in the markets, some of these sort of semi-liquid products, they kind of work, and they kind of work for the long term. They kind of don't necessarily work for the short term.
Right.
And if you're a retiree who all of a sudden needs access to that at that particular moment, how you sort of work around that? Do you do sort of like target dated products where effectively people have to get out before a certain age? And then what happens there? And those are the things that I sort of think about. And just how much leverage is in the system or not around some of these products.
Look, I think those are very fair questions and fair points. What I would say is the approach that we're taking is we don't think anybody should allocate more than 15% of their assets to private assets. And the way we think about it is it's really through a collective investment trust, or to your point, a target date type construct where you have a private asset sleeve, but sitting alongside you have a liquidity sleeve. Now think about that. If that's 15% of your total investable assets, the other 85% is in the public markets, where you clearly do have access. So I think we can approach this in a way that's prudent, that meets the fiduciary standards. And if you think about the length of savings in these programs, I mean, typically people are investing for 25, 30, 35 years, so they actually align pretty well with private assets. And I can acknowledge that from a timing perspective, it may not be ideal. I think the way we think about it at Empower, and we have 19 million customers and $2 trillion on our platform, the way we think about it is we want to provide access, and ultimately it's the fiduciary, the plan sponsor, in conjunction with the advisor and the investment consultant, that actually makes the determination around timing and the underlying strategies that they want to pursue.
Do you think that the fee structure for everybody else is going to come down as a result of this? So when I say that, meaning the private alt community has a fee structure that is meaningfully higher than the public space.
Yes.
The question is, and when you look at some of the returns, it's even hard to actually even figure out what the real returns are, post fees, all of that. Do you think that changes if you have public players playing in that space?
I do, over time. I mean, if you think about the market, it's $12 trillion today, and it's growing at a 6% CAGR. So if you forecast out 10 years, the defined contribution market is going to be a $20 trillion market.
Is there any defined benefit market left?
Very small. Very small. So if you think about a $20 trillion market, you could see over the next 10 years an allocation to privates that's anywhere between 10 and 20%. It's zero today. So the opportunity for investors and for alternative managers is massive. I mean, this could be a $4 or $5 trillion market. I mean, there are some that would advocate more of a 60-40 split, 60% public equities, 40% privates. So I think it's going to take time, Andrew, because, you know, Joe highlighted the executive order, and, you know, we're waiting for clarity, regulatory clarity and direction from the SEC and from the DOL. And that's going to be really important over the coming weeks and months.